Have you ever wondered what the stock market would look like if just a handful of companies held all the power? Well, we don't have to wonder, we're living it. Right now, 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla make up a staggering 32% of the entire S&P 500. Their combined market value is over $14 trillion. To put that in perspective, never before in history has so much wealth been concentrated in so few stocks. And that, my friends, is a recipe for disaster. Let's talk numbers, because they tell a story. These 7 giants, often called the Magnificent Seven, trade at an average price-to-earnings ratio of 42. Historically, market leaders trade closer to 22. To justify these sky-high valuations, these companies would need to grow their earnings by 25% every single year for the next 5 years. But here's the reality check: that's not happening. These companies are no longer scrappy startups. They're mature giants, and their explosive growth is slowing down. Apple's iPhone sales have plateaued. Microsoft's cloud business, while still massive, is growing at a slower pace. Nvidia, the darling of the AI boom, is facing permanent export bans to China. A huge market, growth is decelerating across the board. So, what happens when Wall Street's lofty expectations meet this slowing reality? Valuations compress. Imagine that price-to-earnings ratio dropping from 42 down to 28. Even at 28, it's still well above the historical average. But that simple adjustment would wipe out nearly $5 trillion in value from these 7 stocks alone. Now, you might be thinking, okay, so a few big stocks take a hit. What's that got to do with me? Everything. When almost 1/3 of the market vaporizes, the other 2/3 don't just stand by and watch. They get dragged down with it. We're not talking about a minor correction here. We are looking at a potential market decline of 45 to 50%. This isn't some wild speculation about a distant, uncertain future. This is a mathematical certainty unfolding right now, in real time. The real danger in just the overvaluation. It's the very structure of modern investing. Think about it. How many people do you know have a 401k or own an S&P 500 ETF? Millions. These passive index funds are the bedrock of modern retirement planning. And by design, every single one of them is massively exposed to this risk. Here's how it works. Passive funds do buy stocks based on a deep analysis of their fundamentals or true value. They buy based on size. The bigger a company's market cap, the bigger its share in the index. So, as the prices of the Magnificent Seven soared, index funds were forced to buy more and more of them. This created a powerful feedback loop. Rising prices led to higher index weights, which led to more passive money flowing in, pushing prices even higher. It's a beautiful, self-reinforcing cycle on the way up. But that cycle works both ways, and on the way down, it's catastrophic. When earnings finally disappoint and the growth slowdown becomes undeniable, the selling will begin. As people pull money out of index funds, the funds are forced to sell their holdings. And because these 7 stocks make up such a huge portion of the index, they will be hit the hardest. Falling prices trigger volatility, which forces other types of funds, like risk parity funds, to sell to reduce their leverage. Options traders will hedge their positions, adding even more selling pressure. Momentum strategies that chase these stocks on the way up will flip and accelerate the selling on the way down. What you get is not a gentle correction, but a cascade. A waterfall of forced, mechanical selling that overwhelms any rational buyers trying to find a bottom. The system itself becomes the engine of its own destruction. If this sounds familiar, it's because we've seen this movie before. Go back to the early 1970s and the Nifty 50 bubble. A small group of supposedly invincible, one-decision stocks dominated the market. They were seen as permanent winners that you could buy at any price and hold forever. They traded at extreme valuations, just like our Magnificent Seven today. And what happened? When the economic climate changed and their growth slowed, these invincible stocks collapsed. We're talking 60, 70, even 90% losses. Many of the companies themselves survived, but investors who bought at the peak had to wait 15 years just to get their money back. The parallels to today are chilling. The valuations are extreme, the growth is slowing. The concentration of risk is unprecedented, and passive investing has put the entire market on autopilot, headed straight for a cliff. When the Magnificent Seven finally reprice to reflect reality, the damage won't be contained to just those stocks. The entire market will be dragged down, violently and swiftly. Retirement accounts, pension funds, college savings plans, all the financial pillars that ordinary people rely on will see decades of savings evaporate in a matter of months. I want to be very clear. This is not financial advice. This is an analysis of risk. It's an examination of historical patterns, market structure, and cold, hard math. Extreme valuations cannot survive slowing growth. It's a fundamental law of finance. The only question left is whether investors will recognize this pattern before the crash, or if they'll become the next casualties in a long history of market bubbles. The greatest concentration of risk in modern history is sitting in plain sight. The clock is ticking. Thanks for watching. If this analysis gave you something to think about, please like this video and subscribe to the channel for more deep dives into the forces shaping our financial world. Stay safe and stay informed.